Here's the plain-spoken truth. A 29% compound annual return did not come from wizardry or whisper networks. It came from looking around, noticing what worked in the real world, doing the homework, and holding on long enough for arithmetic to become geometry. Ordinary investors can do this because the world tells you what's winning long before Wall Street does, and your edge is that you're already a customer, neighbor, and observer before you're a shareholder. I didn't bet on interest rates or elections. I bet on companies. The market is a giant distraction from the business stories that matter. If you tune out the noise and keep score the old-fashioned way, sales, earnings, cash, debt, inventory, you can find your own Dunkin' Donuts before it shows up on institutional buy lists. The secret, if there is one, is applying common sense with discipline. Invest in what you know at prices that leave room for reality, and hold until the reason you bought stops being true. Think of this as a field guide, not a sermon. You don't need perfect timing or perfect foresight. You need a repeatable way to notice promising businesses, verify the story with numbers, and let compounding do the heavy lifting. Your daily life is an unbeatable research lab. The best stock ideas often arrive with your coffee, your kid's lunchbox, your weekend errands, or the line out the door at the new place in town. Before analysts write a report, parking lots fill up, products sell out, and friends rave about switching to a better brand is less than #0. 2.5 hash is greater than. When you see that before the narrative hardens and the multiple expands, you're early. Ordinary investors beat professionals here because they're closer to the scene, noticing adoption before the spreadsheet catches up. Invest in what you know doesn't mean invest in what you like or what's popular. It means start where you have genuine familiarity, then test the story with numbers. If you're a nurse, you'll spot the medical device that truly cuts procedure time. If you're a contractor, you'll see which supplier wins repeat orders. If you're a parent, you'll see the brand your kids refuse to switch from. Proximity is an advantage if you convert observation into analysis and never skip the homework. Every stock is a story backed by numbers. The story tells you why the business might be worth more in 5 years. The numbers tell you whether the story fits reality. Great investing marries the two and refuses to compromise. If the story is superb but the numbers are flimsy, pass. If the numbers look fine but the story lacks a growth engine, pass. The 29% way emerged from insisting on both, an understandable edge plus measurable progress. Start by checking simple things. Sales should be rising at a healthy clip in the segment that matters. Earnings need to grow, and not just because someone played with accounting. Cash flow should rhyme with profits. Debt must be manageable. Great companies don't need life support to grow. Inventory should not balloon faster than sales. Shelves are not where growth should sit. Valuation should leave headroom. A reasonable price earnings against growth, or a favorable price to free cash flow, gives the story room to work. When the storyline and the number line track together quarter after quarter, you're onto something. If they diverge, the thesis needs a rewrite or an exit. The moment you can't state in one sentence why the company will be bigger in 3 years, you've lost the plot. A fast way to think clearly is to classify the business before you judge it. Not all growers are created equal. Some businesses are slow growers, utilities, or mature staples you own for dividends and stability rather than 10-baggers. Some are stalwarts, big brands growing modestly where patience and fair price matter. The fast growers are the hunting ground for big winners. Here, you must verify runway, unit economics, and reinvestment capacity. Cyclicals need timing because rebounds aren't necessarily structural growth. Turnarounds deserve a watchful eye on debt, cash burn, and catalysts you can name, not hope for. Most of the outsized returns come from fast growers caught early and held through adolescent volatility into adult dominance. And the trick is knowing which kind of business you're holding, so your expectations and sell rules match its nature. Do the practical work, visit stores, use the product, phone the company if you must, and read the annual report start to finish with a pen in hand. Compare the product to its competitors and ask why customers switch and why they stay. True advantages show up in repeat purchase, renewal rates, pricing power, and word of mouth, not slogans. When you hear the same positive refrain from customers, employees, suppliers, and channel partners, the moat is real enough to merit a position and real money. Amateurs can outperform because they can move fast on small caps institutions can't buy yet. You can buy the scrappy regional chain that doubles locations off a small base. By the time it's a consensus quality compounder, most of the multiple expansion will be over. Your edge is the willingness to investigate small, boring, or overlooked businesses long before they're fashionable. Overpaying amputates future returns. Underpaying for a business that grows into its valuation magnifies them. A simple sanity check is to look at growth against price. If earnings are compounding at 20% and you're paying a mid-teens multiple, you're not paying for perfection. If cash flows are real and growing, a price to free cash flow below peers can signal a mispriced compounding machine. None of this requires calculus, just skepticism and a ruler. Use the PE to growth idea as a compass, not a law. A business growing 20% with a PE near 20 has a PEG near 1, and that's reasonable if returns on capital are high and reinvestment runway is long. If the same business carries debt up to its eyebrows, haircut the score. Keep valuation tools simple, adjustable, and always tethered to the quality of growth. Companies fail for the same reason people do. They run out of money at the wrong time. Favor balance sheets that can take a punch. Debt that swells when rates rise or demand softens is a silent killer. Cash cushions let management invest through downturns, capture, share, and exit recessions stronger than they entered. Profitability is permission to grow. Cash flow is the fuel. Conservative leverage is the seatbelt. When comparing candidates, put survivability first. A slightly slower grower with clean finances beats a flashy one with leverage tied like a boat to the tide. This is how portfolios live to see compounding work. The best way to earn 29% is not to lose 50% when the cycle turns. Inventory tells you a lot about demand. If inventory climbs faster than sales, something is off-channel stuffing, weak sell-through, or poor planning. When sales outpace inventory and margins hold, that's evidence of real demand. Ask whether turns are improving, whether stockouts recur because demand is robust, or whether discounts are needed to clear shelves. Numbers won't hide what pallets of unsold goods reveal. Keep it simple and visual. Sometimes the most powerful analysis is a photo of empty shelves or a parking lot on a Tuesday. Management matters because owners act differently. Look for leaders who talk plainly, admit errors, and allocate capital like it's their own, because it is. A track record of reinvesting at high returns, avoiding diversification, and buying back stock only when it's cheap says more than any glossy deck. If compensation grows faster than per share value, that's a yellow flag. If acquisitions build empires instead of economics, that's red. Interview management in your head with 3 questions. Is less than #0. 5 hashes greater than, what are the 2 numbers you wake up checking? What could make those numbers break? And what will you do if they do? If answers are buzzwords and weather reports, keep walking. The right leaders are specific about drivers, risks, and playbooks. Sell when the original reason you bought is broken. Not because the stock is up or down, but because the business has changed. Maybe a competitor cracked the code. Maybe growth slowed to a crawl with no plan B. Maybe debt crept up and crowded out investment. If the story is intact and the stock falls, that's opportunity. If the story is broken and the stock rises, that's danger. Rotate from the worst of 2 good stories into the better one. Capital is limited. If another company offers the same theme with faster growth, cleaner balance sheet, and equal or better price, move. Ending a good investment for a great one is how portfolios upgrade themselves. Diversification is insurance against being wrong. Too much of it is an admission you have no idea. Hold enough names to survive surprises, but not so many that you can't monitor them. A dozen to a few dozen is the sweet spot for most individuals who do the work. Across sectors, avoid stacking the same risk. 5 retailers are not diversification, mixed business models, end markets, and cash flow patterns so you can sleep when one part of the economy yawns. Rebalancing should be tethered to story and valuation, not calendar dogma. Trim when a position outruns its fundamentals. Add when the thesis advances and price lags. The goal is maximizing time in exceptional businesses, not maximizing trades. Great stocks will test your patience by falling 30% on their way to 10 times. That's the toll. Volatility is not a verdict. It's the cost of sitting in the compounding seat. If you've done the work, draw strength from the thesis and the numbers. If you haven't, volatility will fire you at the bottom and rehire you at the top. Write down your reasons the day you buy. The driver, the metric, the risk, the price paid, and what would change your mind. The page becomes your ballast. If the driver is progressing and the risk hasn't materialized, red numbers aren't a reason to sell. They're an invitation to review and possibly add. Read primary sources first. Letters, transcripts, 10Ks. Summaries are opinion. Filings are facts. Keep a watch list with thesis notes and 2 or 3 key metrics per name and track them quarterly. Visit the product. Buy it, test it, compare it. If you can't, talk to users. Use a 1-minute pitch to force clarity. If you can't explain a business quickly and cleanly, you don't own it yet. Review losers and ask what signal you ignored: debt, inventory, customer churn, and institutionalize the lesson. These boring habits, repeated, do what talent alone can't. They keep you in the game long enough for the math to work. Compounding is multiplication disguised as addition. A business that reinvests profits at high returns scales value even if the market yawns for months. If per share earnings grow 20% for 5 years and the multiple doesn't compress, equity value follows. If the multiple gently expands as the story becomes obvious, that's free tailwind. The goal isn't to predict the market, it's to partner with businesses that don't need prediction to do well. Companies with recurring revenue, pricing power, cost advantages, and long runways are compounding machines. Find 3 to 5 of those in a decade, hold them, and you've done the most important part of the job. Look for repeatable hunting grounds that are often the least glamorous. Regional roll-ups with unit economics, proven locally and room to replicate. Niche leaders with a boring product that is indispensable to a small but growing customer base. Disruptors with switching benefits that stick because they lower cost or save time. And category creators that turn a habit into a brand and a brand into a moat. If a company reinvests at high returns, expands its addressable market sensibly, and posts customer metrics that sing, the rest is time and temperament. Ignore macro forecasts you can't trade and headlines you can't verify. If inflation blips and your company raises prices without losing customers, the story might have improved. If rates jump and your company is net cash, competitors with debt just got kneecapped, the right micro can outrun the wrong macro often enough to make guessing unnecessary. Ignore hot tips. If an idea can't survive a 5-question test, what it does, how it wins, how it grows, how it funds growth, what could kill it, it isn't yours to own. Borrowed conviction is the fastest way to buy high and sell low. If you want to build a 29% CAGR mindset, start with curiosity. Notice lines, sold out signs, and repeated recommendations from regular people. Follow that with skepticism. Confirm the story with numbers and primary documents. Make patience your policy and hold until the reason breaks, not because the calendar turned. Have the courage to buy on the sale when the thesis is intact and the stock isn't, and practice humility and victory by trimming when price sprints ahead of progress and rotating to better uses of capital. This is not a sprint from tip to tip. It's a decade of ordinary days, noticing and verifying, buying and holding, reviewing and adjusting. Done consistently, it stacks years where your winners do most of the talking. To get started tomorrow, Make a list of businesses you encounter, weekly stores, apps, services your circle won't switch from, and note 3 that seem to be winning share. Read their last annual report and write one sentence on how they will grow in the next 3 years, plus 2 metrics to watch. Check debt, cash flow, and whether inventory and sales move sensibly together. If the basics pass, put a small starter position on your radar or watch list. Track quarterly. Did sales and earnings advance? Did cash follow? Did the thesis progress? If yes, and price is reasonable, add in steps. Predefined sell triggers tied to your thesis. Loss of moat, growth stall without remedy, leverage spike, or capital misallocation. You don't need to be louder than the market, just earlier, clearer, and more patient. That's how 29% CAGR got done. One understandable story at a time. Bought at a sane price, owned through the noise, and sold only when the reason to own evaporated. Anyone willing to observe carefully, do the simple math, and hang on, can follow the same path with their own circle of competence in a notebook. Common sense is still the best tool on Wall Street, and it's free.